Welcome again to our second installment of our financial education push. It is a webinar that is geared towards, webinar series, I should say, that's geared towards trying to ensure that the public is aware of certain financial resources and information that they can use and apply in their lives and improve their wealth. Tonight, we're going to be continuing on a similar topic that we kind of hinted on in our last talk. Our last talk was with regard to how do you buy back your debt and secure your future, control your future by buying back your debt and not necessarily throwing that cash through the window by taking your good hard-earned money and just handing it over to an institution, which you did owe, right? So there was an obligation for you to pay it. But the question is, how can we pay it and not lose it, right? And that's what that strategy was about. So we introduced a concept that was maybe familiar or maybe unfamiliar to some folks. I got some good feedback. And one of the feedback was, what is tier one capital? What is a tier one account? And how do I secure tier one capital? And where do I get a tier one account? All right, those are very good questions because, as you know, we try to encourage folks to secure tier one capital and tier one funding, right? So we want to make sure that we are aware of what that is, and that's kind of what we're going to be discussing today. Now, there is an old saying or adage that says that success leaves clues, right? So if we're trying to be successful and we wanting to ensure that we are on the path to building wealth and becoming successful, we want to make sure that we're students of the past. We're student of people and institutions who have done or accomplished what we are trying to accomplish, right? And the center of any economy, or maybe not the center, I would argue that that's not the center, but the core, that is the center, right? But a major part of an economy is their banking system, right? The economy can't survive without people, is the point I'm trying to make. However, a major section or core of the economy is the banking system. So in order to truly, again, understand what is tier one capital, we need to go to the banking system. So I'm going to do the research right in front of your face, right? So that you can essentially do the research along with me, right? So this is a simple search for a tier one asset, or you could simply enter tier one capital, right? And tier one capital, it yields this definition by Investopedia. It simply says that tier one capital refers to the core capital held in a bank's reserves and is used to fund business activities for the bank's clients. It includes common stock as well as disclosed reserves and certain other assets. I would encourage you to just go to Investopedia, kind of get familiarized with that concept because it goes very, even deeper. And this is a good little video that they put together for that as well. Understanding what tier one capital is and versus tier two capital, and also how to calculate that ratio. There's an actual calculation to understand it, because if you are interested in, let's say, investing in a certain bank or a certain institution, then one of the quickest ways to determine whether or not that bank is a stable bank, what you're going to be doing is you're going to try to research their capital ratio, their tier one capital, right? So in fact, there's an article out right here. I'm doing the research right in front of you that says tier one capital is the easy way to see the strength of a bank's balance sheet. So in other words, if you want to go to a balance sheet, you want to make sure that you understand where their tier one capital is and whether or not that's a strong bank, right? Now, That being said, Tier 1 capital can be broken down into even a more simpler concept. It's cash and cash equivalents. Anything that can be liquidated and be available to essentially protect a run on the bank. Because there is ever since 2007, right? And after the crash in 2007, there was the FDIC push for the banks to ensure that they had tier 1 capital. Even this article refers back to that very same definition in Investopedia. But it goes even further into saying that in 2013, regulators approved the Basel III or the Basel Accord in order to better respond to deficiencies that existed in financial regulations that were exposed for all to see in 2007 and 2008. So this whole regime came about as a expressed need to ensure that the banks were secure financially and they weren't essentially running amok off the economy, right? I just want to make sure that everyone is seeing my screen. I'm just yapping along. I'm thinking that you're seeing my screen, but if you want to give me a thumbs up as to whether or not you're seeing my screen or a thumbs down in the chat, that would be helpful. All right, apparently I'm not sharing my screen, so let me go ahead and share my screen. So all this time I've been yapping away and thinking that you're seeing what I was seeing, right? But here we are. All right, this is what I was looking at. Let's go back. Let's return to where we started. All right. So everyone should understand what tier 1 capital is by now, but these are the articles that I was sharing with you earlier on, right? So this is the Investopedia article, right? Essentially saying that tier 1 capital refers to the core capital held in a bank's reserves and is used to fund business activities for the bank's clients. It includes common stock as well as the disclosed reserves and certain other assets. And I said, you can go ahead and take a look at this article. There's a video here that actually supports it as well if you wanted to get into certain more details about what tier 1 capital is. And this is a search that I did. It pulls up obviously the differences between tier 1 and tier 2 and a plethora of information about what tier 1 capital is, right? And in addition to that, I had shared this one specific article that deals with how we look at tier 1 capital. Away. Here it is. All right. So the easiest way for you to know the strength of a bank is looking at their balance sheet and trying to identify their tier 1 capital. The financial meltdown in 2007 essentially precipitated the need for the FDIC to ensure that there was strong capital on the books of the banks to ensure that if there's a run on the banks, they can essentially be taken care of and there won't be any need for a bailout. Remember the too big to fail scenario? They're essentially trying to stem that tide, right? And here we have the Investopedia definition of what is tier 1 capital, and it also refers to the Basel Accord, which was essentially established what tier 1 capital is, right? So the Basel Accord right here, all right? So that being said, what does this have to do with you, right? What does this have to do with you and the need to have tier 1 capital perceivably in your books, right? What's the need for tier 1 capital per se, right? So let's take a look at that. Tier 1 capital is important for you because we're talking about the need to ensure that the books of a bank is secure, right? You should consider yourself as a bank. You should consider yourself as an institution. In fact, we have an entire system that that we encourage our clients to do to essentially establish their own family bank, where you create a family banking system. But in order to do so, you're going to have tier one capital. See, everyone has income. Everyone has some form of capital, whether it be a real estate or capital resources as far as human resources are concerned, or you have an income, whether it be from a job or a business. Everyone has that cash flow, right? Or most people have that cash flow. And but do you have tier one capital? Do you have that reserves that would ensure that if there is a run on the bank, so to speak, or if there's a dire need for you to reach out and get that capital ready and available in an emergency situation, in a significant emergency situation, do you have that readily available, right? So let's talk about that for a second. There's a second concept that I introduced to you last week, which was bank-owned life insurance, right? Or BOLI, B-O-L-I. BOLI is actually considered tier one capital, right? And I'll expand on that in a minute, right? As you can see here in Investopedia, bank-owned life insurance is a product where the bank is the policy beneficiary and usually the owner. So they own the policy and they benefit from any instances that might occur with that policy. Such an insurance is used as a tax shelter and for the financial institutions which leverage its tax-free savings provisions as a funding mechanism for employee benefits, right? And it's just not limited to employee benefits. It can also be expanded to operational costs, right? Being able to tie essentially go through the rough times, right? Where revenues might be thin, right? And be able to keep the business operational, right? So banks actively go out, again, success leaves clues. Banks actively go out and secure these usually permanent life insurance policies to ensure that they can create some form of liquidity in their in their books, right? So let's take a look at what one of these banks look like, what one of the balance sheets of one of these banks, right? So we're just doing our research here right in front of you in real time, right? And this is an actual balance sheet of a very popular bank, right? So where am I getting this information from? As you can see up here, it's FDIC.gov, right? You can do this research on your own and actually pull up the balance sheets of banks. For obvious reasons, I'm not going to reveal the name of the bank, but feel free to take a look at this website in your own time and leisure. Here's what a balance sheet usually has assets and liabilities, right? And we're going to take a look at what the banks refer to as an asset, or what the banks refer to as a liability. And we're going to actually take a look at how much so they've invested in certain assets and do some comparisons, right? So this is a very major bank. If you're watching this, you probably have a bank account there, right? And here's one of the, in line 41, it lists life insurance as an asset, right? To the tune of 12,192,000. Now, let's be clear about this. If I carefully scroll up, I don't want to reveal the name of the bank, right? So if we clearly see that this says the dollar figures are in the thousands, it simply means that if I scroll back down to line 41, that 12 million is actually $12 billion in life insurance, right? 12 billion with a B dollars, right? Because we're going to be adding 3 more zeros at the end of this to make it a significant asset class that they're holding, right? So the question you should be asking is, why is this bank where I have in fact, I have a bank account there, right? Where I have my bank account, has so much life insurance and they list it as an asset, right? Now, that being said, let's take a look at one of the more popular asset classes, one that you're probably investing in, real estate. Let's see how much real estate this, for comparison, how much real estate this bank specifically has. It says here, other real estate owned $218 million. 218 million compared to 12.192 billion. Right? So the question is, this popular asset class that everyone is investing in, why are they not investing more in real estate as opposed to investing so much in a specific asset class, such as life insurance? Well, for a couple of reasons, right? The benefits of creating this structure in their business is tremendous, right? The first one is, let's go over that with go on a little chart right here and discuss that. So the first major benefit of having a life insurance policy as a, let's say, a key man life insurance policy on one of their key executives, maybe one of their employees, maybe a CEO or someone who is very instrumental in the operation of the business, is because life insurance offers a significant amount of steady growth rate, right? And it's not just that the growth rate is blockbuster or anything like that. It's steady. In other words, you don't lose the gains that you secure. So there are products that essentially have you be able to make market rates, sometimes decent market rates, where the market is going up and you're essentially locked in with your profits. So when everyone else is in the market and they're doing something similar to maybe this, right? And then maybe that, right? And maybe this, you're not participating in those wild swings, right? So the growth rate is a significant and secure way of growing their money, right? The second thing is it affords them a significant tax shelter, right? So we're looking at sheltering all the growth in life insurance, primarily because the federal government thought that it's an important asset to have to ensure that that the coverage of a breadwinner or the coverage of someone who owns a business who may pass. They don't want to be meddling in the business of having to tax that, right? So they essentially said, you know what, this specific asset class is going to remain tax free, right? So that is a significant benefit for them. Good growth rate, and especially at a zero tax rate or preferred tax rate, that is a tremendous boon on their behalf, right? The third is liquidity, right? So if they need cash at any given time, in order for, first of all, in order for that $12 billion to exist on their asset, on their balance sheet, right? That specific $12 billion has to be liquid. In other words, you can't list something that's illiquid on your balance sheet, right? If it's something that you can't liquidate right away, you can't put it there, right? I think I made that point, right? So you can always access this cash at any given time, as they say, to fund employee benefits, maybe fund the purchase of real estate, right? 218 million of it, right? Maybe they just take up a fraction of that life insurance policy. Think about that for a second. They're capable of participating in the real estate market at a level that no one else can, primarily because they have a good resource in that liquid life insurance, right? The fourth is they obviously get to protect a key person, right? So they're protecting the loss of, let's say, a significant breadwinner, right? Someone who is gonna uh, be a significant reason why their business is growing, right? And I'd even suggest or argue that it's more effective for a mom and pop business, a small business, maybe a dentist, maybe an attorney, maybe a realtor, maybe someone who is truly dependent on this income, right? If you're a solo shop, right, and you're a restaurant and you're a mom and pop restaurant, and it just so happens that one of the owners passed, that's a significant event for that restaurant, right? They can't quickly replace that breadwinner, right? So if we have a sudden flood of cash that was owned by that specific business, that would actually come into the business, providing some liquidity for that rainy day, they could hire a transition team, right? They could ensure that the operation of the business remains uninterrupted, right? In a larger corporation, I get it. If the CEO passes or maybe a big sales executive passes, that's very important. But you have 10,000 employees deep, right? And it's not so much a significant event, and they know this. Yet and still, they have $12 billion off that to make sure that does never that event never occurs, right? So again, if success leaves clues, we should be picking up the clues that are being dropped on this journey as we try to understand what tier one capital is, right? Now, tier one capital is just a group of capital assets. It's not necessarily just life insurance, right? But we're focusing on this one specific asset class because it's accessible to all of us, right? As opposed to maybe as what they refer to common stock, right? We can't purchase $12 billion of common stock and compete against these larger corporations, right? But we can certainly control a significant life insurance policy that has a certain death benefit that would protect us, right? And the other thing about this specific strategy is the funding limits are much more generous than other asset classes. So if you should try to open an IRA, right? The funding limit, depending on what kind of IRA you open, is 6K, right? Per year, right? And that is a start, but if you're running a restaurant and you're generating $250,000 a year, right? And you can certainly save about 50,000 out of that $250,000. You're limited to what you can do, right? If you're just focusing on an IRA, right, or some other asset class, right? So you can certainly have a generous funding limits. I've sat down and designed plans that you can literally have a pretty much an unlimited amount of cash, depending on how the design is done, right? Put into these products. So imagine a firm that might be generating $1.2 million a year, right? And they can certainly control their expenses within that $200,000, and they had a wonderful year, and they want to make sure that that $1 million is secured, trapped, getting significant growth rate. It's a tax shelter. It's liquid. They can use it at any given time, and they want to make sure it protects against any loss of a key person, right? And clearly it has significant funding limits. This is just a few, just a few of the benefits of using this strategy, right? So now we know what tier one capital is. The question is, why do you need it, right? You might not own a business, right? Clearly, it's very good for a business owner, right? That would need some form of security, securing their cash flow, ensuring that this cash flow is consistent and constant, and they can always reinvest in their business. Why would you need it? Let's talk about a family. Let's talk about a family first. The family's example, why would you need it? Well, last week we discussed how do we control our debt? How do we essentially purchase our debt and control our future, right? So in any given home, we have some income, right? We have some expenses, right? And we have those we can't change, right? So we have then we have debt, right? In any given home, depending on which home you're in. Some homes are pretty good and they have no debt, but pretty much most of America would have some form of debt, right? So we have, let's say, an income of $5,000, right? And we have expenses that would be split between, well, we'll have two categories. We're going to split this between expenses, it's like light, water kind of stuff. And then we're talking about debt, maybe a mortgage and, credit cards and car loans and all that good student loans and all that good stuff, right? Question is, how do we spread this across $5,000 across these two categories and not neglect yet a third category, which is savings, right? We want to make sure that we're saving for the future, right? And yes, last week we spoke about the 50, 30, 20 rule, right? Where you want to be saving 20%. This is where you want to be saving 20% of your income, right? And maybe some wants would be here, right? And maybe these expenses and the debt would essentially be in the 50%, right? What we learned is that most households compromise and they say, you know what, we're going to cut off some of these wants because in reality, we can't just use 50% to pay for mortgage, credit cards, light, phone, water, like, all of this stuff. We're going to cut this out and maybe devote 80% of our income towards these activities. And yet some others might say, you know what, that's just still not enough. We need to cut this out and start saving, right? 100%, putting 100% of our income, right? We have more month than we have money, right? So there's a deficit. So what's the solution? The solution is first, we need to ensure that we have a budget, right? Want to make sure that we have a budget that essentially respects the 50-30-20 rule. And this is not necessarily a hard and fast rule. It is just a good guideline to follow, right? Because in fact, my household, I've modified the 50-30-20, right? My goal is to save, right, approximately 80%, right, at the time, right? That's my goal, right? So I've modified the 50-30-20, and you can play with those numbers as they are needed. So we're looking at splitting that $5,000 across $2,500 over here. What's up? $1,500 here and $1,000 here. Right. So if you're not saving $1,000 per month, then we need to readjust, right? So we discussed that maybe we could focus on a goal of trying to save after we've gone over our budget and cut some stuff out, save maybe $500 to $1,000 per month in what we call tier 1 capital, right? Tier 1 capital would essentially provide, just as the bank is being protected, protect you in the case of certain financial catastrophe, right? Which financial catastrophe are we talking about? Well, number one, if I should die, right? I'm a significant breadwinner in my home. It's gonna have a significant impact in this household, right? But thank be to God, we have coverage, right? So tier one capital provides that instant coverage for that key person, right? So it's a same concept, or we're just using a different structure. The family, it's the same banking concept that we're using for a similar structure, right? So here we are. I'm one of the key persons in this organization, so to speak, right? And if I should pass, there's a significant hit on this organization, and as a result, that coverage will smooth things over for a significant amount of time, right? So it gives them peace of mind, and it gives me peace of mind, and it also essentially guarantees that their future isn't held up because we did poor planning, right? That's number one. Number two, we are supposed to be saving, right? We're supposed to be paying ourselves first, right? And if we're talking about trying to save to the tune of what we saw in that bank, $12.192 billion, right? We need to be about the business of saving, right? So if we're talking about saving maybe $500 per month for the first 12 months or so, then we're looking at potentially, well, in reality, when we talk about the cost of insurance and all that kind of stuff, it's roughly around $2,000 to $6,000, right? That you're gonna have access to as capital, right? Why is that important? It's important because if you were in debt, and you should know by now that debt is a enemy of savings, right? I just talk about that compromise. You compromise your savings to make sure that you could continue paying debt and expenses over here, right? So expenses are not going to go anywhere. We need light, we need water, right? But we certainly can eliminate some of the debt, right? And in order to do so, if we've accrued a certain amount of capital, right? And we have, let's say, a credit card that's the balance on it is maybe $1,500, and we're spending $200 per month on that credit card. Well, guess what? We can borrow against this tier one cap, the $1,500 that would eliminate this debt, right? And that very same $200 I'm sorry, that's not 200K, it's $200. That same $200, right, would now go towards my saving strategy, right? So now I'm saving $700 as opposed to this $500. So I'm getting closer to getting to my savings goal of $1,000 per month. So now I'm saving 700 bucks, right? Then the next time around, I might be able to save a little bit more, right? And now my bank has grown from $2,000 to $6,000 to maybe $6,000 to $10,000, right? And then I could identify certain debt that I don't know, maybe it's $5,000, right? I'm paying $400 a month on that debt, right? Then what'll happen is I'll go ahead and borrow from again my family bank and pay that debt off, right? Eliminate it altogether, and then add this to my savings strategy, right? That's the crux of what we discussed last week, right? So now we're at $1,100, right, in savings, right? We've surpassed our goal of saving $1,000 per month, right? And we just keep on rinsing and repeating until we can certainly say that we've now controlled all of our debt. We own all of our debt, right? And we essentially are trying to save a whole lot more. That's in the context of a family, right? And obviously, once you've saved, now you can start investing in certain asset classes. You can start purchasing real estate using this very same strategy. Start purchasing stocks, whatever floats your boat, right? You can start expanding. But what's the point is your tier one capital is the capital that's always going to protect you. I call this serious money. Serious money. That's where my serious money is, right? So anything outside of that is money that I can risk, right? But I will never risk my serious money. Here's another component about this is this. If I had that $500 per month times 12, right? And now I have 2 to 6K in my serious money account. Guess what? It doesn't leave the account. It's trapped. It's locked away, literally locked away. Because what I said to you, when I'm accessing that, this is a lock, by the way. So it's not a good way to draw. But anyway, that money is locked away primarily because whenever I access that money, I'm simply using that money as collateral, and I get a loan from the insurance company for the equivalent of what's here, $6,000, right? That money is still here, safely locked away and earning an interest rate while I'm using the insurance company's dollars to invest, right? To pay off debt, right? To cover salary, whatever the situation is, right? I'm using that as a means to improve my financial situation, right? And obviously I'm going to pay it back, but if you were following along last week, it's a payback that results in a zero wash loan. In fact, there are some instances where you'd actually be making money by paying it back. How do you make money by paying it back, you asked? Well, I'm glad you asked, right? You're making money by paying off your debt in a couple of ways. The first one is interest capture. So if you're looking at a debt that's 6K and you're essentially paying 17% to Capital One for that loan, and you went to your bank, your family bank, and the insurance company loaned you that 6K, and they say, you know what, just make sure you pay us back to the tune of 4%. You have literally just captured 13% of your money back. So you're actually making money, paying off your debt. Isn't that something, right? Number two, the other way that you're making money, right, is through the investment growth in your activities, right? So let's say, for example, you decided to invest the 6K, right? You went out and you purchased a rental property, and that rental property, you use the 6K as a down payment, and that rental property is now paying you $1,000 per month, right? $1,000 per month is equivalent to what? $12,000 per year, right? Guess where you're going to put that $12,000? You're going to put that $12,000 right back into your family bank. Guess what you just made by taking that money to invest in real estate, right? You've paid off that loan. So the loan over here, you paid off that loan. It's no longer a liability. So the money is still has been there making money for you. And now you added an additional $12,000. That's a 200% rate of return. 200% rate of return, right? Now, there are tons of different strategies you could use with this. And the other component is, I don't want to be too long-winded, is in the context of a business. All right, so let's talk about a business for a second. All right, if you're a business owner and you don't have key person coverage or key person protection, you are at a significant risk. You're putting your business and your family at significant risk, and you're missing out on a tremendous opportunity to grow your business. How is that? Everything I just said applies. The same concept with the family. The breadwinner is a key person, right? If that person is lost, then your business might suffer a lot, may even shutter and shut down, right? That being said, if you are gonna use that key person coverage for your business, then you not only are going to be protected when that person is gone, but you can also borrow against that capital. You got it. Yeah, I know what you're thinking. Borrow the capital, right? And use it to expand your business. Maybe you wanted a second location, and that would be the reason, a second location. Maybe you needed to hire another employee, right? Maybe you needed to purchase some equipment, right? Maybe you needed to file a patent. Maybe you needed to get some marketing done, right? The point is, you're borrowing this capital to get a certain rate of return that will go back into your family. Well, this is no longer your family bank. This is what we call corporate owned life insurance, right? Just like a BOLI, if you recall, right, over here, just like a BOLI, right, for banks own life insurance, we can actually research the equivalent of that. It's called a COLI, right? E. coli. All right, not E. coli, but COLI, right? And it's right here. Investopedia has that the equivalent article of corporate-owned life insurance. This life insurance provides financial protection for millions of people in America. Now, so the nature and purpose, as the name states, COLI refers to life insurance that is purchased by a corporation for its own use, right? So we're looking at COLI for your restaurant, for your legal practice, for your mortgage practice, for whatever business you're running. You need to ensure that that is there so that you can have secure your capital. And much like the family situation, once that money is in there, it is trapped. It is secured. It's not going anywhere because you're not going to go in there to raid it, right? And treat it like a piggy bank, right? Money in, money out. That's what they've been teaching us to do. Money in, money out. I earn the income. I'm gonna pay Capital One. It's a good way to keep my credit good. Yeah, that's a start, right? But how are you gonna get out of debt in a short period of time, right? And how are you? And that's another thing. If you're in debt in your business, the very same strategy that I just explained, you can use that for your business as well, right? Make sure that you are requesting to have COLI in your business, right? Everything I just explained is applicable. You're just simply transposing the players, right? The key person is the breadwinner, right? And that the business is a family, right? So the concept I just explained to you is family banking, and the concept I'm explaining to you is obviously business banking, right? Where you essentially are going to be growing your COLI to a significant level, right? Think about what's going to happen when you purchase that equipment. When you get that new employee who is a killer, right? You get that second location, right? And it's a killer, right? Think about what's going to happen to your bottom line. Where are you going to put that bottom line? You're going to trap it, right? In a product that offers good growth rate. Remember those benefits? That's steady with no losses, right? It's going to be tax sheltered. Don't forget it. It's liquid, so you can access it at any given time, right? And if that key person is passes away, you are protected, right? And because the limits are generous, right? There, if you have a wonderful year, you can actually stack or pack in that cash into that lockbox, right? You can keep on just stacking that cash into that lockbox, and it's rinse and repeat, rinse and repeat. All right, so that's it for today. I hope you enjoyed it. This is a series that we're trying to put out of financial literacy. And obviously, this is unconventional wisdom, right? Not a lot of people are aware of these things, right? These are some of the best kept secrets for banks and some of the most wealthy individuals in the world, really, not just America, that use this strategy for different purposes. Now, I am going to entertain any questions that you might have. And if you don't, I'm actually going to um, shut it down. If there are any questions? All right. All right. If there are no questions in the chat, you can always find us on YouTube. We are our group is called Family Faithful Wealth. Faithful Wealth. We're trying to essentially provide some sort of information for our existing clients as well as future clients that would give them the opportunity to take care of that. So I did get a question. Do you pay a fee to maintain this account? The fee that you're going to be paying is the premium that you're going to be putting into the account. So it's essentially, if you're saving $500 per month, there's a portion of that $500 that goes towards the cost of insurance and the cost of investing in the various indices, right? So that's the only information that's the only fee that you would actually pay, right? So it's if it's properly designed, you can certainly accrue a whole lot more than that $500 would afford you. Good question, though. All right. Any other questions? I'll give it another minute before I shut it down. Again, I hope you enjoyed it. I hope this information was useful to you. And we will pick up next week again on another topic. And I try to make it as very current. I do get feedback from folks who log in. And if it's useful to you and you have some feedback, I might just pivot and do something different. But this is definitely something that you could go back and replay on our YouTube channel or have some discussion in the comment section or reach out to us at Faithful Wealth. By the way, we do have a group called Faithful Wealth, so feel free to join that. It's a free group. It's an educational group. There's no fee to join. It's open to the public. All right. Thank you so much. All right, you guys have a wonderful night, and I hope this was useful to you. Make sure that you check out our group, Faithful Wealth, or on our YouTube. All right, we'll talk to you.